Okay, guys, this week we're going to talk about the last topic of this semester in this class. So, and after this week, I will let you do a revision on the past materials, and also I will talk about what will be covered in the final exam. Again, in the final exam, we're going to do a 24-hour take-home exam, and we're gonna have a couple of questions so you can finish and send it back to me through email. But anyway, we're gonna talk about the exam details next week. So the last topic, it's about options and their valuations. We talk about the valuation of the stocks. We also talk about the valuation of bonds, right? But whether it's the valuation of the stocks or it's the valuation of the bonds, they have some similarity, right? In the sense of if you buy a stock, you expect to receive cash flow over time, right? When you buy a bond, you also expect to receive cash flows over time. But of course, there are some differences, which is when you buy the stock, the future cash flow it's uncertain, right? The dividends it's uncertain. The firm's cash flow it is also uncertain. But at least at each period, you're gonna look at the cash flow and calculate the present value of these stream of cash flows generated from the stock, right? You know, and in other cases, for example, if you buy the bond, then the things are a little bit different in the sense of the cash flow you receive in each period is fixed, right? If you buy the bond, but still, these two security, when you value them, they have the similarity, which is they have a stream of cash flow, right? And it happens every time, right? What happens every period, right? Whether it's certain or uncertain, there's a cash flow anyway, right? But option it's a little bit different. That's what we talk about at the end of this semester, right? It is different because it is different because the cash flow they are not continuous. So when you buy an option, the cash flow happens not every period, right? Just one period. Right? So that's why valuing options is very different from valuing bonds and stocks. But options, and also options, the valuation of the option is also important because, option is very important financial instrument, right? So that's why we need to talk about how to value option. But this topic is basically covering the two chapters in the book. Let me check which two topics. Is chapter 20, chapter 21, right? So what we'll do is that we first introduce what is an option, right? Then we move on to valuation models. So when we talk about what is valuation, we're going to talk about the definition of option, of course, right? And then how do you achieve? How do you protect yourself, right? How do you protect you against downside risk using option? How do you achieve upside potential using option, right? And what affects option values, right? What determines the option value? And then we're going to talk about a series of valuation model, going from the simple option valuation model and Black-Scholes valuation model, which is a very, very popular model practitioners use in valuing option. So let's look at an option as an example, right? First of all, the coffee roaster Pure Green Mountain buys options that put a ceiling on the price that it will pay in its future purchase of beans. Right? So basically, this is an option where this company, Green Mountain, has the right, right, has the right to purchase the beans in the future time at a pre-agreed on price, right? Second, Flatiron offers its president a bonus if the company's stock price exceeds 120. This is an option as well because it's like you don't receive the bonus right away, right? But whenever the price is higher than some level, then you receive a bonus. Right? Third one, Blisden Computer dips a toe in the water and enters a new market. Right? This is also like an option because you don't know how the situation will be when you enter into this market, right? It could be good, it could be bad, right? You don't know it. But whenever you choose to exercise this option, exercise this investment, or do this investment, right? You are entering into option. So these are three examples of options, and we have three options more, three examples more, right? In 2004, Air France acquires this company KLM, right, in exchange for a package of Air France shares and warrants. All right, these warrants entitle KLM's shareholder, which is target shareholder, to buy the acquired shares for $20 each within the next 3.5 years, right? So this is giving the shareholder the right to buy those shares, right? You don't have to buy it. You just have the right to buy it. And in 2011, AIG distributes 75 million warrants to its shareholders, right? Each warrant entitles shareholder to buy a national share for 45, right? Again, this is giving shareholder the right to buy shares, right? It's not that you have to buy it. You just have the right to buy it. And in general, investors regularly trade options on common stocks, right? But the important thing here is that the value of the option actually depends on the underlying asset, right? So that is also why option is called financial derivative. Right? Why it's derivative? Because the value of the option is derived from the underlying asset, which is the stock. Right? That's the idea. So in general, we have call option and a put option, right? If you have a call option, that basically gives the owner the right to buy stock at a specified exercise or strike price on or before a specified maturity date. Right? So for example, if you buy an option, this option can potentially say in 6 months from now on, right? You buy an option and the option says in 6 months from now, right? You can buy, let's say, Apple stock at the specified price, let's say $100, right? So this is like an option. That is, you have the right to buy stock at a specified exercise price, right? In the example I just mentioned, it's $100, right? And you can do it on the date of 6 months later, or you can do anytime during the 6 months. Right? So if the option can be exercised only at a maturity, it is conventionally known as the European call. Right? So that is, you can only exercise it in 6 months from now. Right? In other cases, the option can be exercised on or at any time before maturity. Right? So then this is known as the American option, American call. Right? So that's the difference between European call and American call. Now let's look at one table that shows the selected prices of put and call options on Google stock. So for example, let's look at this one, right? For example, the maturity date is June 2015, right? The first one. Exercise price is 470, right? That means you can buy the stock at 470, right? In June 2015. Yeah? And this is price of a call option. This is the price of put option. Right? So what is a put option? Put option is exactly the opposite, right? You have the right to sell the stock in the future, right? At a specified maturity date, right? On or before. So if it's American, if it's American put, that means you can sell this. You have the right to sell this particular stock on or before maturity date. Right? So it's the other way around. So you have the price of the call option, you have the price of the put option. Right? So the first entry here, right, says you can for $72.7 you could acquire an option to buy one share of Google stock for 470 on or before March 2015. Right, this one. Oh, sorry, this one. Right, March 2015. Right. And of course, that's American call, right? Because Google is an American company, right? And in general, if you look at the the price of call option and exercise price. So you can already find a pattern. Right? When exercise price increases, the price of the call decreases, right? But the price of put option goes the other way around, right? When exercise price goes up, the price of the put option goes up. Yeah. So the option price increases as option maturity extended as well, right? So let's go back to here, right? So now let's compare March 2015 and June 2015, right? The exercise price is the same. Let's compare the first row, 470, right? Now, the maturity date of June 2015, it's longer, right? It's later. I mean, it's more distant to the current time. So in that case, you can see the price is 80.5, right? The price of the option is higher, right? And again, if you look at the price of put option, that's the same thing, right? The price of the option, no matter it's call or put, increases with the maturity date, right? And same thing when you compare June 2015 and January 2016. All right, the price here for June 2015 is lower, right? That's the pattern we find. So this is what I just said, right? So at exercise price of 530, the March call option cost 28. The June option cost 36, right? And the January 2016 option cost 54.6. Right? 530, 530, right? 530. So this is the pattern we find. Now let's look at the diagram, which we call a position diagram, that can reflect, right? Reflect the relationship between the value of the option and the share price, right? Because like I said, the value of the option, the value of the financial derivative is derived or depends on the value of the underlying asset, which is the value of the stock, right? Which is the share price. That's why we need to understand how does the stock price affects the value of the option. Right? Now in the left diagram, you can see, because what is a call option, right? Again, call option is call option gives you the right to buy the Google stock, right? At 530, right? On or before the maturity date. That's about it, right? Now, what is the value of this call, right? So if the actual stock price falls below 530, right? This call is useless, right? This right is useless, right? Because I mean, obviously you can see, I mean, this gives you the right to buy the stock at 530, right? But actual price is below 530, right? So then this is valueless, right? Nobody wants to exercise this option, right? I can directly buy the stock at the lower price. That's why in this case, the value of the call is actually 0, right? It's almost like, you know, sometimes in the national, like, university entrance exam in China, right? They have this special rule for some people, some kind of students who actually have obtained some kind of benefits, right, for the exam. For example, one potential beneficial rule for these students is like, as long as your final university entrance exam score is higher than some level, let's say 500, right? The university will admit you, right? Now, it's the same thing, right? Remember, this is like an option, right? So as long as your final grade is higher than 500, now you can exercise this option and enter the university. Now, this right has no value at all if your university exam score is lower than 500, right? If you're lower than 500, of course you cannot enter into the university. Now you cannot use this particular rule, this particular beneficial rule to enter into university, right? So that's why the graph looks like this, right? Only when the actual stock price is higher than this level, then the call option is valuable, right? It's valuable because you can buy the stock at a lower price than the actual price, right? So this is the value of the call option. Now the same thing goes the opposite way for the put option, right? Suppose you buy a put option whose exercise price is 530, right? Now, if the actual price of this stock option is lower than 530, now you have some benefit from having this put option. Why? Because you can sell at the higher price than the market price, right? Which is good for you, right? That's why for any price that is lower than 530, you have some benefits, right? The value of the put option is positive, right? Now, as long as the share price goes closer and closer to 530, right, your benefit goes down. Why? Because the potential benefit, I mean, the potential difference you can exploit by selling at a high price becomes lower, right? Because the actual market price goes closer and closer to 530, right? So that's why the value of the put is 0 when a market price is exactly at 530, right? And by the way, when a price is exactly at the exercise price, right? In our case, the exercise price is 530. We call these options that are options at the money or at the money options, right? Because the actual stock price, they are exactly at the exercise price. Now, in the put option case, right? If the stock price is higher than 530, then your put option has no value at all, right? Because I mean, if the actual price is 600, why do I bother to exercise my put option to sell at the lower exercise price, which is 530? Right? That's kind of the trouble, right? Now this is the position diagram, right, which tells you the relation between the value of the call, the value of the option, and the share price. Now remember, this is the relation between the value of the call and the share price, right? Now this is not telling you about the profit. So profit diagram, it's a different kind of diagram, because in the profit diagram, you have to take into account the cost of buying options, right? For example, each option maybe costs $10 each, right? You need to take into account the value or the cost of buying the option. So this is what I just said, right? So I already explained this. Now let's look at the put option. So a put option actually gives you the right to sell the share, like I just said, right? So let's look at this entry, right? 530, this entry. Now for this entry, the put options price is 34.55, right? So what that means is that for 34.55, you could acquire an option to sell Google stock for a price of 530 anytime before June 2015, right? Or before June 2015, right? So again, if you look at this option, this put option, right? If Google share price immediately before expiration turns out to be greater than 530, right? Then the put option is valueless, right? You could sell at a higher price that is available on the market. And you would actually do better to sell the share in the market, and your put option will be valueless, right? So now, in general, you can see what is the value of put option at expiration. It is the exercise price minus the market price of the share, right? That is 530 minus 440, right? For example, if the market price is 440, right? Yeah, here they don't have the market price, but suppose we assume that exercise price is 130, actual market price is 440. Now in that case, the value of the put option is $90, and the difference. Now, of course, you can calculate the value of call options. You can look at the value of the call option, right? For the value of the call option, that's the other way around, right? That's the market price of the share minus the exercise price, right? Suppose the market price is 600, right? And the exercise price is 530, right? In that case, the value of the call option will be 600 minus 530, which will be 70. Right? So this is the value of the call option. So now we are looking at this option problem from the buyer perspective, right? Now we can look at the question on the other way around, from the other side, right, which is the seller side. So what is the benefit? What's your payoff when you actually sell call option and put option? So if you sell a call option, you promise to deliver shares if asked to do so by a call buyer, right? I mean, unless there's a buyer, there must be a seller out there, right? So if the share price is below the exercise price when the option matures, then the buyer will not exercise the call. No, in that case, your liability will be zero, right? Remember, buyer's gain is seller's liability, right? So that means if buyer has benefited from the call option, that means the seller actually has to lose, right? Because they have to deliver the share. So that's why if the stock price rises above the exercise price, the buyer will exercise and the seller must give up the shares. Right? Now let's look at one example. Suppose that the price of Google stock turns out to be 600, right? This is above the exercise price of 530. Now, in that case, the buyer will exercise the call. Right? The seller is forced to sell stock worth 600 for only 530. So in that case, the seller has to deliver the share, right? Now in that case, the seller's payoff will be 70. Right now, remember, the actual price is 600. So that means the seller the cost of kind of delivering the share is 600, right? Now the exercise price is only 530, right? Now in that case, the seller's net payoff is minus 70, right? He loses 70, right? It's almost like, the seller has to buy from the stock market 600, right? And then have to deliver it to the buyer. Now in that case, the seller has a payoff of negative 70, right? But again, like I said, seller's loss is buyer's gain, right? That's why 70 loss is buyer's gain. Now we can flip the buyer's diagram, right? Which we just talked about. We can flip the buyer's diagram around, right? Flip the buyer's diagram around and we get the payoffs to the seller, right? Now suppose initially, let's flip the buyer's diagram, right? For a seller, let's look at the value of the call seller's position and the share price, right? So if the stock price is below 530, right? If it's below 530, like we just talked about, right? The call is valueless, so that's why the buyer will not exercise, right? In that case, the seller liability is zero, right? Now, as long as the stock price goes above 130, now the buyer will have to exercise, and the value of the call to the buyer is the actual price that is higher than the 530 minus 530, right? So then, the negative of that will be the seller's payoff, right? So that's why this part, when the share price is higher than 530, the seller's payoff is negative, right? And it's more negative when the price is higher and higher, right? Because when the price is higher, the buyer gains more and more, right? The seller loses more and more. Right? They're all mirror image. And the right diagram is for the put seller's option. That's the same thing, right? So initially, when the share price is lower than 530, right? In that case, the put option is valuable for the buyer of the put option. Now, in our case, the put seller will exercise the option, right? So if they exercise the option, the put seller has to deliver, right? They have to deliver. They have to sell it, right? They have to sell it for the buyer. So in that case, their payoff is also negative, right? And also it's more negative when the share price is very, very low, right? So this because this gives a great advantage to the buyer. And when the actual share price is higher than 530, right? Now in that case, the put option has no value to the buyer. So that's why the put buyer will not exercise it, right? And then in that case, this also has no liability for the seller, for the put seller, right? So that's why they are zero. So to summarize, right, for every dollar the buyer makes, the seller loses a dollar, right? Because like I said, it's just exactly the opposite, right? You gain 50, right? The seller loses 50, right? So they are exactly the same. The seller will be safe as long as the share price remains above 130. All right, but will lose money if the share price falls below this figure, right? This is for the put option. Okay? This is for the put option, right? For again, remember, for the put option, the lower the price, the better for the buyer, right? And so if it's better for the buyer, that is worse for the seller. Now let's look at the profit diagram, right? So like I just described, what we have been talking about? We're describing the relation between the value of the option and the actual share price, right? But that is different from the actual profit, because if you consider the actual profit, right, you have to consider the cost of the option. That's why on the left one, on the left diagram, this is the profit to the put buyer. So you can see we are just doing a parallel shift, right? Initially, the position diagram is like this, right? 0 until 530 and then goes up, right? Now we're just parallelly shift this curve down, shift the segment down, right? Well, why do we need to shift it down? Because we have to consider the cost of option, right? So the implication is simple, right? If the price is lower than 530, right, the option is valueless, but the buyer has to pay the cost of buying the option, right? So that's why their payoff is negative. So now based on that, there's a break-even point. The break-even point should be 530 plus 36. Now remember, the cost option is 36, right? So that's why the price of the stock has to at least be 566, right? Cover the cost of buying the call option, right, from the buyer. Right? Similar thing, we can look at the profit to the put seller, right? So for the put seller, initially the diagram goes from here, right? Goes from here to here and then directly here, right? Now we just parallelly shift this segment up, right? Remember, any cost from the buyer is seller's benefit. All right. Suppose the put option is worth 34.55, right? So in our case, you can see the break-even point for the seller is 530 minus 34.55, right? So what that means is that the 34.44 is the proceeds from selling the Google put to the payoffs. Right? So, the implication is that the stock price can actually, if the stock price is lower than this break-even point, 495.45, right? So this becomes seller's liability, right? The seller has to deliver, and the seller will have negative payoffs, right? Now, if the stock price is higher than 494.45, then that's okay for the seller, right? Because they still can gain from the proceeds of selling the Google put option, right, to the buyer. Now, this is the first part of our discussion. Now let's look at how do we use option to protect investors from downside risk and to kind of use the option to achieve better upside potential. So here are the 3 diagrams, right? Now, the first diagram is simple. It's just like directly buying one share of the stock, right? There's no option involved. Directly buying the stock, right? The diagram B, it is also quite illustrative, right? But diagram B says that there's no downside risk, right? Now you can see if the stock price goes below 530, right? The buyer's payoff, the investor's payoff it is still fixed. Right? This is the worst case scenario. Right? They are still positive, so they are protected downside. Right? Now, if the stop price goes up, then they have the upside, right? Because they have the, imagine this guy buys a call option, right? So then this guy enjoys the upside, right? So we just need to combine some positions in order to eliminate the downside. Now, the last one, diagram C, this is the worst case scenario, right? There's no upside, meaning that when the stop price goes up, your payoff is fixed, right? No matter how the price is higher, your payoff is fixed. Now, when the stop price goes down, you have unlimited downside, right? So this is bad because your downside risk is maximized, whereas there's no upside at all, right? This is the one we hate. Now, this is a brief explanation of the three diagrams I just went through. Now let's look at the worst case scenario first, right? See how we can combine options and stock purchases, right? In order to achieve this worst case scenario. So the worst case scenario is here, right? So what can we do to achieve it? Right? I mean, one way to go here is that, so let's combine the direct buying share, right, and call selling. Right? This is the way to kind of achieve this no upside potential case, right? So this diagram we already see, right? This is the diagram when the seller sells a call option, right? Because as you can see, when the stop price is higher than 530, which is the exercise price, then this is the gain for the buyer, but losses for the seller, right? So that's what diagram two shows you the seller's payoff when they are selling a call with 530 exercise price. Right? Now diagram C shows the consequence of having two positions together. Right? Now, if the stop price declines below 530, right? Now the call option is valueless. That is true. The call option is valueless. The buyer will not exercise. That is true. But you also have the stock position here. You already bought a stock, right? That's why when the stock price goes down, you also lose, right? You also lose. Now, if the stock price goes above 130, now you also are not happy because you are the seller of this call option, right? When the stock price is higher than the exercise price, the buyer is happy, but you are not happy, right? You have to deliver the share for the buyer, right? So that's why this is when we combine direct stock purchase with the call option selling, right? You have this worst case scenario where your downside risk is limited, but you have no upside potential at all. Now let's look at how can we achieve a better situation, right? How can we eliminate the downside whereas maximizing the upside, right? So here, so these are the two ways we can do it. The first row, the second row, right? Now let's look at the first row. So the diagram 1, 2, right? So here I use 1, 2 because this tells you this is the diagram in the first row, but on the second one, right? So basically this one, right? So this is two position, right? The first position is you buy one share of the stock, right? The second position you buy a put option, right? And the exercise of the put option is 530, right? Now in our case, what will happen, right? If the stock price goes above 530, this put option is valueless, right? That's for sure. Because I mean, put option is only valuable when actual stock price is below the exercise price, right? No, that is okay because you have the share, right? You already directly bought one share. You can directly pay from an investment in the share, right? That is cool. Now, put option helps you protect the downside. That's why when the stock price goes below 530, you can exercise a put option and sell your stock for 530. Right? That's the idea. Now, basically, the idea is that you can add a put option to your investment, your direct investment in the stock. Right? In that case, you have protected yourself against any losses. Right? You have eliminated your downside. So The only cost here is, I mean, buying a put, right? That's the only option. That's the only cost you have. Now let's look at the second rule. The second rule is another way of eliminating the downside whereas maximizing the upside, right? This time, the way, the way we do is that we first do a bank deposit, right? And then we also buy the call option. So again, I use diagram 212223, right? Now diagram 21, this one, right? This is bank deposit, right? This shows the payoff from placing the present value of 530 in the bank account, right? And diagram 22 is the second one. This is the call option, our familiar diagram that shows the payoff from a call option on Google with an exercise price of 530. No? And finally, diagram 23 shows the effect of combining these two positions. Now you can see why this can protect you on the downside, whereas maximizing the upside, right? Because if the stock price goes up to 600, right, you will have 130 in the bank and a call worth 70, right? Because now your call option is valuable. Right? Now, it also protects you from the downside because if the stock price goes below 130, right, the call option is valueless, right? That is fine, but you still have the bank deposit. So the worst thing you can lose, the worst amount you can lose is locked into 530. Right? This is, you always have 530, right? Your payoff is constant at 530, right? No matter how the stock price goes down below 530. Right? That's why you can see if you combine these two options or these two positions, you actually are protected from the downside, whereas you can maximize your upside. All right, so this is the kind of what we have just said. Now, in the kind of second diagram, which I mean in the two strategy we have talked about, right? One strategy is buy call, the other strategy is buy put, right? We can see their payoff is actually equivalent, right? Now, right? So you can look at this graph, right? The final payoff of buying put and buying call, these two strategies, they're actually equivalent. Now let's have this, think about this more, right? So if you buy the share and then put option to sell it for 530, right? So this is the first strategy. And you actually receive the same payoff structure. The payoff structure is actually the same as from buying a call option and setting enough money to pay the 500 exercise price. I mean, this is referring to the fact that you deposit 530, right? You deposit 130 in order to protect you from the downside. Now, in our case, we have this equivalence here. That is the value of the call plus the present value of the exercise price will be equal to the value of the put option plus the share price. All right? So this is the equivalence we have seen, right? Again, two strategies. The first strategy is you buy a share and a put option, right? So this is the right-hand side, the value of the put plus the share price. Right? And the left-hand side is the second strategy. Second strategy is you deposit the present value of the exercise price, right? Which in our case is 530, right? And you also buy a call. Right? So that's why these two strategies are equivalent in terms of payoffs. So buy call invest the present value of exercise price in safe assets, right? Which is deposit in the bank 530. This is identical to the payoff from buy put and buy one share. And this basic relationship among the share price, call, and the put values, and the present value of the exercise price, right? This relationship we have just discovered is called put-call parity. Put-call parity. That's a very important principle in option valuation. So again, the idea is that, like we just said, right? In both cases, the combination of these two positions have protect you from the downside, right? Meaning that it help you eliminate the downside, whereas maximizing the upside, right? So now we can rearrange the relationship a little bit, right, to solve for the value of a put option, for example. Right? So basically, we can twist the put-call parity formula, right, and then we can get value of the put. Value of the put will be equal to value of the call plus the present value of exercise price minus the share price. Right? I mean, in other words, this is we are still using this formula. We're still using this formula. So buy put and the buy one share is identical buy call and invest present value of exercise price in the safe asset. So we just moved that part, right? So in other words, the buy put, the value of the buy put will be identical to buy call and invest the present value of the exercise price in the safe asset and sell one share, right? These are all equivalent. Now we can use this relationship to show that what is the value of the call, right? What is, I mean, how are these two equivalent? So these two graphs, right, shows you the equation, right? So on the right hand side, this on the rightmost panel, this is the value of buying a put, right? This is buying a put. Now the left three is the three actions, three positions we have just talked about. The first one is buying a car. The second one is depositing the present value of the exercise price, right? The third one is sell one share. Right? So in summary, the strategy of buying a call, depositing the present value of the exercise price, and selling the stock is equivalent to buying a put, right? Or put call parity. Now we can look at one example. Diagram 1 shows the payoff from the call option on Google stock with the exercise price of 130, right? Diagram 2 shows the payoff from exercising or placing the present value of 530 in the bank, right? And regardless what happens, this investment will be 530, right? Because it's just depositing, it's safe asset. Now, for example, suppose that an option matures and the stock price is 440, right? Your call will be worthless, but you are good because the bank deposit will be 530, right? And it will cost you 440 to repurchase the shares. So your total payoff will be 0 plus 530 minus 440. Right? And your total payoff will be 90, right? This will be exactly equal to the same payoff from the put. Right? This is what we have just talked about, right? One example. First of all, you buy the car. Second, you deposit in the bank. Third, you sell one share. When you sell one share, when you sell one share, it's reflected here. That will be equal to the payoff on the buying a put. Right? That's the idea. So we have just talked about the put call parity, right? The application, right? So let's look at this example again, right? So when the actual price is 440, right? The call is valueless, right? Your deposit is 530, right? So it is still 530, right? Now remember what's the put call parity? It's the value of the put equals value of the call plus present value of exercise price minus share price. So minus share price, right? For what's the actual price now? It's 440. Yeah? I mean, then this will be equal to the value of the put. Now, if the actual price is 440 and the exercise price is 530, right? The value of the put is what? Is the exercise price minus the actual stop price, right? Which is 90, right? This is exactly the same payoff from the put. Let's look at another example. In December 2014, the price of a 6-month call with a 530 exercise price was $36. The interest rate was 0.25% for 6 months, right? And the price of Google stock was 530. So the cost of a homemade put, why it's called homemade pay, because you don't have to buy a put, right? You can combine these 3 positions and achieve the same payoff from buying a put. Right? Now, in that case, you can buy a call option, which is 36, right? That's the value of the call, right? The price of value is 36, right? Plus the present value of the exercise price, that is 530 divided by 1.0025, right? Minus the share price. What is the actual share price? It is 530, right? Now you can get this is the value of the put. This is actually very similar to the call, to the put price at that time. Next, we're gonna look at some real examples of option, right? They don't, I mean, it's not like a financial option, but indeed, they have an option structure in it, right? So the example we're gonna talk about is related to the CEO compensation or manager compensation. So at the end of the year, Mrs. Higdon will be paid a bonus of 50,000 for every dollar that the price of the stock exceeds its current figure of 120. Right? So now you can see this has an option feature because if the stock price is lower than that, they get nothing. Right? And also there is a ceiling for the maximum bonus. The maximum bonus is 2 million. Right? Now we can think about this example as Mrs. Higdon has only like 50,000 tickets, right? And then for these 50,000 tickets, each of them pays nothing if the stock price fails to beat 220. Right? So only when the stock performance is higher than 120, then this option begins to work, right? And the value of each ticket, if the stock price is higher than 120, now in our case, the value of the ticket will go up by $1 for each dollar rise in the stock price, right? But there is a ceiling, that there's a final limit to it, which is 2 million, right? So then this translates into 40, right? So which means as long as the stock price is lower than 160, then the value of the ticket goes up by $1 for each dollar rise in the stock price, right? But if the stock price is higher than 160, right, the CEO, this manager, does not gain anymore, right? Because he has already got the maximum bonus, 2 million. So this is the payoff diagram. Right? So below 120, nothing happens. Between 120 and 160, right? So every dollar, the CEO gains the corresponding bonus, right? If the stock price is higher than 160, the CEO also stop getting paid for the bonus. Now we can. This is a real situation, real kind of situation of compensation, right? And then this has an option feature. And we can exactly replicate a payoff structure using the combination of options, right? So first of all, the solid black line, right? This is the call option, right? This is a call option with exercise price of 120. Yeah? We can combine this one with the sale of a call with an exercise price of 160. Right? And then these combined one give you the exact payoffs for this compensation structure. So why is this case? If the price is below 120, both calls will be worthless, right? So I mean your payoff will be 0, right? This is the same with the actual compensation example. When the price is between 120 and 160, right? This is in the middle. Now in that case, the 120 call is valuable, but the 160 call is not valuable, so the buyer will not exercise it. In that case, the 120 call will be exercised, and the buyer gets the price minus the 120. Right? So it will be like just the call option here. Right? Now, if the price is greater than 160, then in that case, the 120 option is good, right? The 160 option is also good. But remember, we are selling the 160 call. So anything buyers gain from this 160 put will be our losses, right? So in that case, the payoff, the total payoff will be X minus 120, right? X is the stock price, right? And then minus our losses from selling this 160 call. That will be X minus 160, right? This is buyer's gain, but will be our losses, right? And the result is the total payoff will be 40, right? So that this is the final horizontal line here, right? So that's why you can see when we combine these two options, right, by just kind of differentiating our position, right? Buy one call, sell another call, we have replicated the compensation structure in our example. So the cost of offering this incentive is essentially the difference between the value of 50,000 call options, and this 50,000 call option has the exercise price of 120, right? And also you need to sell another 50,000 calls with exercise price 160. So that is, any set of contingent payoffs can be constructed with a mixture of simple options on the asset. Right? And essentially, you can create any position diagram with as many ups and downs as your imagination allows by buying and selling the right combination of puts and calls. That is the takeaway. Now, finally, for the first part, we're going to look at the determinants of option values. I mean, this is a kind of leading discussion to our discussion of the second part of option, which is the option valuation. But before that, we're going to talk about the kind of determinants of the value of the option. Now, let's first look at this diagram, right? So this diagram shows you the relation between the value of the call option and the share price. Right? Now, this tells you the potential values of price, right, an option can have, right? So basically, all the possible values of these call values, right, they are bounded by this shaded region. And you have a lower bound, you also have an upper bound. Right? So the lower bound is when the value of the call equals payoff if exercised immediately. This is the lower bound, right? So the difference, so now you can see the difference between the lower bound and the upper bound is just a difference in terms of the timing of exercise. If you exercise immediately, this will be the value of the call. If you exercise before, if you exercise not immediately, right? If you don't exercise immediately, that will be the potential upper bound. That's the value of the call equals the share price. So first of all, let's look at the lower bound, right? So if Google stock price is below 530, right, the call will be worthless, right? This is this part, right? And then if the stock price is above 130, and the call will be worth 530 less than the value of the stock. Right, it's here. So then, even before the maturity, the price of the option can never remain below the heavy lower bound line. Right? So meaning that the price of the option can never be lower than this one. It can never be lower than the price you can get from exercising immediately. Right? So for example, let's look at this one using one example. If your option were priced at $10 and the stock price were priced at 560. Now, in that case, it will pay any investor to sell the stock and then buy it back by purchasing the option and then exercising for an additional 530. So you can see that's why the price can never be lower than this lower bound. The lower bound is the maximum between the stock price minus the exercise price and zero. Whoever is the larger one. Right? And this is the bottom line. So we also have an upper bound. The upper bound is a diagonal line, which we saw here. This is the diagonal line. So why it's the upper bound? The upper bound is the The option cannot give a higher ultimate payoff than the stock, right? So why is that? Because if the option has expired, right, at the option's expiration, the stock price ends up above the exercise price, then the value is worth the stock price less the exercise price. Because you always have to, you remember, you always have to deduct the exercise price, right? I mean, the worst case scenario or the ideal situation is when exercise price is zero, right? But we know that this can never happen. As long as you have a positive exercise price, right? Then your final payoff will be less than the actual stock price minus the exercise price. And if the stock price ends below the exercise price, the option is worthless, right? But in that case, the stock owner still has a valuable security, right? So that's why the payoff can never be higher than the stock itself. So let's look at one example. So in this example, suppose we exercise the option, and the actual stock price now is greater than 530. Yeah. Now in that case, if you own a stock, then your payoff is the stock price. If you own the option, then the payoff is the stock price minus 530, right? This is your exercise price. And you can, if we compare the stock and option, we conclude that the extra payoff from holding stock instead of option is 530. Now, second, if if we don't exercise the option, in that case, stock price is lower than 530. I mean, because there are only two situations for the stock price. It can either be greater than 530 or it could be lower than 530. So if it's the second case, the latter case, whereas the stock price is lower than 530, right? In that case, if you own a stock, you still get 530, right? But in that case, options has no value, right? So the option payoff is zero. Now in that case, the actual payoff from holding the stock is the stock price itself. So that's why in that case, in general, option price must be somewhere in the shaded region. So again, it cannot be higher than the stock price. Right? That's why this is the upper bound, right? And also it must be lower, it must be higher than the lower bound. Now let's take a further look at the specific points here, points A, B, C, right? Now we all know point C. We all know point A, right? So point A is when a stock is worthless. So when a stock is worthless, of course, the option is worthless as well. Right? I mean, who wants to buy a stock that is only worth $0? And nobody wants to buy it. And again, this is also consistent with our prior observation. When a stock price increases, the value of the option increases, right? Given a certain exercise price. Right? So, I mean, this is obvious, right? Because suppose the exercise price is 500, right? Now the stock price goes to 600. Now the value of the call is 100, right? If the stock price goes to 700, now the value of the call is 200, right? That's why the higher the stock price, the more profit you get from buying this call option. Now point B. Point B is when the stock price becomes large, right? When the stock price becomes large, the option approaches the stock price less the present value of the exercise price. So you can see here the share price is high here, right? Now in that case, what is the value of the call? It will be the stock price less the present value of the exercise price. Right? And in that case, the higher the stock price, the higher is the probability that the option will eventually be exercised. So if it's exercised, immediately it's here, right? If it's not exercised, it's here. So if the stop price is high enough, then exercise becomes a virtual certainty. Then you go to this line, this lower bound. Now, what's the difference between B and another point here that has the same value of the call? The difference is because of the share price. Right? Now, what's the difference between point B and the same point with the exact share price, right? If the share price is exactly the same, B has a higher call. So you can see B has a high call value. Right? Then this point on this lower bound has a lower call value. Right? This is because the point on this lower bound, this is when you exercise immediately. Right? The point B, you haven't exercised it. Right? There are still some time before exercising it, right? You haven't exercised. That's why there's a difference here. So basically, investors who acquire stock by buying a call option, they are buying on credit. Basically, they pay the purchase price of the option today, but they do not pay the exercise price until they actually take up the option. Right? So the delay in the payment is particularly valuable if interest rates are high and the option has a long maturity. Right? Again, right? So they pay the option price today. They buy the option, but they don't pay the exercise price until they want to exercise it. Right? So that's why this delay in the payment is particularly valuable if interest rates are high and the option has a longer maturity. Yeah? Therefore, the value of the option increases with both the rate of interest and the time maturity. Right? And this also explains why, right? Here, when you have the same actual price, if you haven't exercised yet, the value of the call option is higher, right? Relative to if you have the same share price but you exercise immediately, right? This value comes from the fact that there is an interest, right? There is an interest rate here. That's why there's a difference, and that's why the value of option increases with both the rate of interest and the time to maturity. So let's continue. So again, we have just talked about, let's say we have the same price, right? We have the same actual price. Now, if you have a longer maturity, that in that case, the value of the call will be higher, right? And then we say it's because of the interest rates, right? And simply because if you can pay later, right? You can maybe, let's say the exercise price is 500, right? Now, if you don't have to pay the exercise price today, you can deposit, right? You can deposit this amount of exercise price into the bank and earn the interest, right? And then this additional interest payments or interest kind of advantage, right? That explains why even if you have the same actual price, right? There is a discrepancy between an option which has a longer maturity, right, versus the option that you have to exercise right away. And this also explains why the value of the option increases with the time to maturity. Finally, let's look at point C, right? Point C is where the option price always exceeds its minimum value, except the stop price is zero. As long as the stop price is non-zero, the option price always exceeds its minimum value. So at point C, the stop price equals exactly the exercise price. We call this kind of option at the money option, right? We have already talked about in the beginning of this class. So in our case, the option is worthless if exercised today, right? Because the value of the call is the actual stop price minus the exercise price, right? If they're equal, then the value is zero. Right? So that's why at this point the value of the call is zero. Now again, here is the effect of the time, right? The magic played by the maturity. Now, suppose the price of today, um, suppose the price is exactly equal to the exercise price, but now we still have 3 months, right, before the option expiration. Right? Now, in that case, let's look at the payoff, right? It's no longer zero. Right? If the stock price goes up, there like with 50% probability, then you still have some positive upside, right? If the stock price falls, there will be zero. Right? Now, as long as you have some kind of time, some kind of window before the maturity of your option, you still have to gain from the call option. Okay? That's why the option price at C exceeds its lower bound, right? Because C is zero, right? This is when the exercise price equals this is when the exercise price equals the stock price. The reason is that you have this uncertainty here, right? If you calculate the expected payoff, they are exactly positive. Right? So that's why one of the most important determinants of the difference between actual and the lower bound value is the likelihood of substantial movement in the stock price. Right? And actually, more volatile, the more valuable option is. Because remember, if you buy the call option, you are protected downside. The worst case that can happen to you is zero. So you are not afraid of the option price being too low, right? You can enjoy the upside, whereas being protected from the downside. So that's why if the volatility is like 1%, 2%, there's not worth much, right? If you buy an option that can, where the stock price can go half or double, then this is valuable, right? Because when the stock price goes half, right, you probably, I mean, the call is worthless, right? You're just protected downside. The value is just zero, right? You don't lose, right? But you fully enjoy the upside because when the stock price goes up like 2 times, right? Now you will be much better off. Now let's consider two stocks, X and Y. Each of X and Y is priced at 100, right? The only difference is that the outlook for Y is much less easy to predict. And there is a 50% chance that the price of Y will rise to 150 and a similar chance that it will fall to 70, right? In contrast, there's a 50-50 chance that the price of X will either rise to 130 or fall to 70, right? Right. Now, in that case, you can see Y has a greater upside potential, right? Because it can rise to 150, whereas X can only rise to 130, right? And Y also has a lower downside, right? It can go down to 70, but X can go down to 90, right? Now, in that case, you can see obviously Y is better, right? Suppose you are offering a call option on each of these stocks with exercise price of 100, right? Now you can see if the stock price falls, they both give you zero, right? If the stock price goes up, then Y gives you a much better upside. That's why since the chance of a zero payoff is the same, the option Y is worth more than. Again, it gives you a higher upside. So the uncertain outlook for Y stock price shows up in the wider probability distribution of future prices. I mean, it has a greater upside potential. That's why you like Y more, right? It's because it's coming from the greater spread of outcomes for Y. So in general, we can look at the relationship between the value of the option and the share price, right, with different volatility. So this upper line, which is this red line, assumes a much higher level of uncertainty about Google's future stock price. And then you can see the value of the options is higher, right, on this line, along this red frontier. The lower curved line, which is the kind of dark colored line here, right? This has a lower degree of volatility. That's why the value is lower. Again, the reason is that the higher volatility, the higher the volatility, the greater the upside potential, right? Given that you're already protected downside. So in general, the probability of large stock price changes during the remaining life of an option depends on two things, right? First of all, volatility, right? Volatility is higher, there will be much greater chances of a price going up, right? And also the maturity, the time to maturity, right? The number of periods until the option expires. So again, this is like we just said, right? The value of an option is increasing in the volatility of the stock and also increasing in the time to maturity, right? You would like to hold an option with a longer life ahead of it. So the value of an option increases with both the volatility and the time to maturity. So this is the table that summarizes what we have just discussed, right? Suppose there is an increase in the stock price, then this is good news for the option price. Option price will be increasing. Second, if the exercise price is higher, this would be bad news for the option. This is but this is for call option in particular, right? And if the interest rate is higher, so this is also positive, right? Why? Because like I said, you can take advantage of the interest rate higher, but if the interest rate is higher, during the time from when you buy the call option till the option maturity, you can deposit your exercise price in the bank in the high interest rate. This increases the value of the call. Right? And also time to expiration, right? Again, we said the value of the call increases with the time to maturity. That's why if the time to expiration is higher, the option price is also higher. Finally, volatility, right? Volatility is higher, greater upside potential, then the option price is also high. Right? And upper bound, lower bound, we have just talked about, right? For the upper bound, the option price is always less than the stop price, right? Remember, you always have to pay the exercise price, right? Lower bound is when you exercise immediately, right? In that case, the value of the call will be equal to the actual price minus the exercise price, right? The call price can never fall below the payoff to immediate exercise. And if the stock is worthless, the call is worthless, right? And then when the stock price becomes very large, the call price approaches the stock price less the present value of the exercise price. So this is the factors that can potentially affect the option value. And this will be beneficial, right? When we move on to talk about the valuation of the option. So when we talk about the valuation of the option, we're gonna look at three methods here. The first one is a simple option valuation model. The second one is a binomial method for valuing options. And finally, the Black-Scholes formula, right, which is a continuous time generalization or extension of the binomial method. Yeah. Well, first of all, we're going to point out the differences between valuing a stock and valuing a bond and versus valuing an option, right? You can see, obviously, they're different because there's no payoffs in each period, right? You exercise, you get a payoff, then that's it, right? It's just a discrete payoff that happens when you exercise the option. So the standard procedure for valuing assets is to figure out the expected cash flow and discount and the opportunity cost of capital, right? But this is not practical for options, right? Because the first step is messy but feasible, right? I mean, you can figure out that one period cash flow, but I mean, what is the discount rate, right? So that's why finding out the discount rate, the cost of capital is impossible because the risk of an option changes every time the stock moves. Right? Again, like we said, the actual stock price actually affects the value of the call. That's why we cannot figure out the single discount rate we can use because it's changing every time, anytime. So that's why the way to kind of value an option is trying to find the option equivalent, right? But this is actually proposed by Black-Scholes, right? The kind of trick or the kind of intuition for valuing an option is to set up an option equivalent by combining common stock investment and borrowing, right? Because when we have the common stock and borrowing, then it's easier to find out the value, right? So how do we find out those option equivalents? So let's consider a 6-month call option on Google stock with an exercise price of 130 in December 2014. Right? So let's pick a day when a Google stock was also trading at 530. Right? This is at a money option, just like we said, right? Then we also assume that there's a short-term risk-free interest rate that was 100% or 1% for 6 months, right? And if you compound this 1% for 6 months to a year, this will be equivalent to 2.01% a year. Right? Now let's suppose the stock price can go up and go down. Yeah? Suppose the Google stock price can go up to 662.5, right? And also can go down to 440 to 424, right? The current price is 530, of course, right? So that means it can go it can go up by 25%. It can go down by 20%. Right? Now, if the stock price goes down to 400 cents, right? In that case, the call option will be worthless. Now, if the stock price goes up to 662, then in that case, the option will be worth the actual price minus the exercise price. Now, in that case, the possible payoffs to the option will be this one, right? So if the stock price is lower, then the option is worthless. If the stock price is higher, then the option price will be equal to the actual stock price minus the exercise price. And let's compare this payoff with what you will get if you bought 0.5526 Google shares and borrow the present value of the exercise price, right? To borrow the present value of 235.56. Right? So we are showing you this is the option equivalent. Right? So if you buy this 0.556 shares of Google, when the stock price is lower, 424, the value of a share is 264.56, right? If the stock price is higher, then you have a different value of your shares, right? Now, if you borrow this present value, you have to pay the principal and also together with the interest rate. This is the repayment of loan plus the interest rate, which already equals to this number. So again, this is the present value of the present value is equal to 235.56. Right? So that's why this is already the value of your repayment of the loan plus the interest rate. Right? That's why in the first case, when the stock price is lower, you get zero, right? Because I mean, you get payoff on the shares, but actually you have to pay back the bank, right? That's why the net payoff is zero, right? In the second case, the better scenario, the payoff is equal to what you get in the better scenario with an option, with a call option. So in our case, you can see there's an equivalent here, right? So the payoffs from the lever invested in the stock are identical to the payoffs from the call option. That is, the value of the call is equal to the value of the common stock holdings, right? Minus how much you have to pay back the loan. Right? That is the value of the stock minus how much you borrow, right? So that will be equal to, this is 0.556 shares that you own times the current price, right? 530 minus, again, this is the present value of your borrowing, right? That will be 235.56 discounted to now, right? Discounted to present, 1.01. Now this is the value of the call. Right? So you can already see the idea. The idea is that we borrow money and buy stock in a way that we exactly replicate a payoff from the call option. And this is called a replicating portfolio. Right? And here the number of shares needed to replicate one call is called hedge ratio or option delta. Option delta, right? And here our call is replicated by a lever position in 0.556 shares, right? That's why the option delta here is 0.556. Now, in general, how do we calculate this option delta? Now, there's a formula for this option delta. This option delta is calculated as the spread of possible option prices. Option prices are already given here. Right? So the spread option prices, that is the better cases minus the worst case, right? And then divided by the spread of possible share prices, right? In the better case, the stock price will be 662.5 minus 424, right? This way you get option delta. Right? This is the amount of shares you have to buy in order to construct this option equivalent. Now, we can look at this. So using this option delta, we have already calculated the value of the call, right? Now let's look at this value of the call for a little bit, right? If the option price is higher than this number, right, then you can make a certain profit by buying the stock and selling a call option and borrowing the present value, right? This is how you can make profit. Right? Similarly, if the option price is less than 61.22, in that case, you can make an equally certain profit by selling the shares, buying a call, and then lending the balance, right? All opposite kind of operations, right? In either case, there will be an arbitrage opportunity, right? So that's why we can assume investors, they are indifferent about risk. So remember how we construct this one, right? We construct this one by constructing the kind of a replicating portfolio, right? Which gives you a same set of payoffs, right? And then we derive the value of the call from the value of this replicating portfolio. This is how we do it. And you can see this one. So when we calculate this value, investors must be risk neutral, right? Because if the option price is higher than 61.22, right, or less than 61.22, there will be arbitrage opportunity, right? So the idea here is that you can see our option price we get from here, right? So it kind of assumes that there is no arbitrage opportunity, right? And then this arbitrage opportunity is actually riskless. So even if the investors they are risk averse or the investors that are risk seeking, it doesn't matter for this arbitrage opportunity. There will be always an arbitrage opportunity if the option price is different from 61.22. That's why we can also call this valuation method that's a risk neutral valuation. Right? It's a risk neutral valuation. Now let's actually explore this risk neutral valuation, right? Suppose that the investors they are risk neutral, meaning that they're indifferent to risk. So if they're indifferent to risk, then it doesn't make a difference for them to buy a stock versus to buy a risk-free asset like a bank loan. Now in that case, the expected return on Google stock will be equal to 1% per 6 months, right? And then we can calculate the expected return on Google stock, which will be equal to the probability of a stock increase times the 25, right? And then plus 1 minus probability of rise times minus 20%. Right? So again, we say that they can increase 20%, 25%, they can decrease 20%, right? And then the expected return here will be equal to the risk-free rate. Right? And that's why we can calculate the probability rise will be equal to 46% basically. Now, remember, this is assuming risk neutral, right? I mean, in the real world, the expected return on Google stock can never be equal to the expected return on the risk-free rate, because common stock, it is always more risky, right, than the riskless asset, than a safe asset. That's why the true probability is always greater than 46%. Right? In general, how do we calculate this probability of rise, right? It will be equal to this formula, right? It will be equal to the interest rate minus the downside change divided by the upside change minus the downside change. Right? In our case, will be the interest rate is 1%, downside change is minus 20%, upside change 25%. Then we can calculate this probability of rise that is equal to 46.7%. And the expected value of the call in our case, right? It will be the probability of the rise, right? Times, right? This is how much the option is worth, right? When the stock prices goes up by 25%. This is how much the option will be worth when the stock price goes down by 20%. Right? Then putting this number, we can get the expected value of the call is 61.83. Now, again, this is the expected value of the call, right? You need to discount it to now, right? Then you get 61.22, right? The same number we get from this replicating portfolio. Yeah, this is, but you can see actually this way, it is easier, right? It is easier to use this risk neutral valuation method to calculate the value of the call as of now. Well, in general, there are two ways to calculate the value of an option, right? The first way is you can find the combination. You can find a combination of stock and loan that replicates an investment in the option, right? Because these two strategies, they are identical, they give you identical payoffs in the future. They must sell for the same price to pay, right? So you can readily calculate the price from this replicating portfolio, and then this price will be equal to the value. The alternative way is the risk neutral valuation, right? Pretend that investors do not care about the risk. So the expected return on stock will be equal to the expected return from the interest rate. Now let's look at this example, right? To value Google put option. Suppose there's a 6 months Google put option with a 530 exercise price, right? And we continue to assume that the stock price can go up 25% and go down 40%. Yeah? And again, if the stock price goes up, the option to sell for 530 will be worthless, right? Because this is a put option. Yeah? If the price goes down by 20%, then the put option will be worth 530 minus 424. It will be equal to 106. Right? Therefore, the payoffs to the put is laid out here, right? So if the stock price is lower, then the value of the option is higher and be equal to 106, right? If the stock price is higher, then the option is worthless. Right? Now again, we use this kind of replicating portfolio way to do it, right? So we calculate the option delta here. Again, use this formula. The spread of the option price is 0 minus 106, right? And divided by the possible share prices, right? And the option delta will be negative 0.4444, right? Now in that case, what that implies is that you can actually replicate the option payoff by selling, right? This time it's selling 0.4444 Google shares and landing the present value of 294.44. All right. So then we can look at the payoffs, right? Then the net payoffs, again, it's similar to the call option we have seen previously. We can then you can see we actually replicate the option payoffs here. Yeah? That's why now finally the value of the put will be so this is selling, right? 0.4444 share of Google Store, right? Times because if you sell, right, you gain, right? So that's why this is the positive payoff plus the value of the bank loan, right? Which will be 294.44 divided by 1.01. This is the value of the put you can get. So one kind of quick question here: how do you get this amount that you need to lend or borrow, right? How do you get this 294.4 here, and how do you get this the balance that you need to borrow in the previous case, right? The simple idea is just that in order to replicate the option payoff in this state, right? This is the amount you have to borrow. I mean, it's just as simple as that, right? In order to replicate this payoff, right? You already know that you have to sell 0.4444 shares, right? When the price is low. Right? Now, in our case, the difference between the total payoff and the selling proceeds, this will be the amount you lend. This is how you get it. Now you already get the value of the put So that's 55.97. Right? Now next we can use the risk neutral method here. What is the, so first of all, in order to use the risk neutral method, we need to calculate the probability of the stock price increase, right? Now we have calculated previously already. That is 0.4666, right? Then we can, and then we have to, then we can use the probability increase, right? And then calculate the expected value of the put option, right? Again, this is the two state, right? In the stock price increase case, the put option is worthless, right? In the stock price decrease case, is 106, right? In our case, the expected value of the put option will be 56.53, right? And the current value of the puts will be this expected future value discounted to null, right? And it will be 55.97. Right? So in general, we have looked at these two ways to calculate the value of the option, right? So first one is to look at the replicating portfolio. The second one is to look at the to use the risk neutral method to value the option. And we can also look at use the relationship between the call and the put prices, right? The put call parity to solve it, right? So in our case, it will be, so what is the value of the put? It will be equal to the value of the call plus the present value of exercise price minus the share price, right? Which will be equal to what is the value of the call, right? The value of the call we have calculated previously, right? In the previous example, we have calculated the value of the call, which is 61.22, right? Plus the present value of the exercise price, which is 530 divided by 1 plus 1%, minus the actual share price now, right? This gives you the value of the put, right? Exactly the same answer we got before. Okay, now let's move on to talk about the binomial method for valuing option, right? So essentially, the trick in pricing any option is to set up a package of investment in the stock and the loan. So again, it's related to the previous method we have talked about, right? We construct a replicating portfolio and then look at the value of that replicating portfolio. So there are two possible price changes in each 3-month period, suppose, right? And then this will give a wider variety of 6-month prices. Right? And we could go on to take shorter and shorter intervals, with each interval showing 2 possible changes in Google stock price and giving an even wider selection of 6-month prices, right? This is almost like for every 3 months, there will be a stock price change, right? And then conditional on the first 3 months, for the next 3 months, there will be another additional movements. So this graph shows the binomial method for value option, right? So in the first 3 months, for example, right, this is the possible price changes, right? Go up 25%, go down 20%. And this is the probability of price decrease and price increase, right? Now we roll on the window, right? After the first 3 months, for the next 3 months, these are the possible scenarios, right? They can go up with 37.1% chances they will further increase. With 27.1 chances they will further decrease, right? And then with some chances there will be no price change. They will go back to the original price. This is the cases, right? Now you can see why does the percentage or the percentage price changes are different here. It's because we are calculating unconditional probability again here, right? Because this is already taking into account the fact that there's further changes here, right? And this is the C. The panel C here shows 26 moves, one every week, right? This is more stock price movements, right? More frequent stock price movements, right? This will be look like this. And then this is the probability distribution of the price changes. So again, for panel A, this is single up and down move each 6 months. Right? For panel B, this is two moves and one each 3 months, right? Every month, every 6 months, every 3 months there will be a stock price change. Every 3 months there will be a stock price change. And then the pedal C, this is 26 moves and one every week. And again, we use the idea of this binomial method is that we still construct replicating portfolio, right? And then we use the value of the replicating portfolio to get the value of the option. And alternatively, we can use the risk neutral method as well. But no matter what method we use, we need to calculate at each point the expected future value of the option, then discount it back at the risk-free interest rate. Okay? So we look at the very last months of the option expiration, and then move it backwards. Right? This is the way we follow in a two-step binomial method. So suppose we use the replicating portfolio method, then we must recalculate the investment in the stock at each point using the formula for the option delta. Okay? So the formula for the option delta, it is still the same, right? It will be equal to the spread of possible option prices divided by the spread of possible stop prices. So let's look at this two-step binomial method. Originally, the stop price is 530, right? This is now. In 3 months, it could go up 20%. It can go down 20%. Right? Now, in another 3 months, they can go up to 726, right? They can also refer back to 530, right? They can also go further down to 360.57. Now, suppose the interest rate is 0.5% a quarter, and assume that in each 3 months period, the price will either rise by 17.09% or fall by 14.6%. Now, suppose the investor demand a return of 0.5% a quarter. In our case, what is the probability at each stage that the stock price will rise? Now we are calculating the stock price increase, the probability of rise now, right? Now we are using a risk neutral method here because we assume that the interest rate is the expected return that investors want from the option. Now we have the final values already, right? So because for this option, for this call option, right? If the stop price is lower than or equal to 530, the option is worthless, right? If the option is higher than 530, then the option is valuable, right? The value of the option will be equal to this final bigger price minus the exercise price. That is equal to 196.65. Right? This is the final value. So we already have these possible values already here, right? Now we can calculate the probability increase here, right? So we need to know the probability increase at this stage first, right? So the probability increase will be interest rate, right, minus the downside change. Downside change is 14.6%. The upside change is 17.1%. Now in our case, we can calculate the probability increase will be 47.64 change, right? So which means there will be a 47.6% of increase and 1 minus this number, which is 52% chance of a fall. In that case, we can calculate the expected return. That expected return must be equal to 0.5%. And we use that, we already can confirm this, right? So which satisfies the risk neutral method. So we have just back out the prices in the previous nodes. So we first calculate, let's review this a little bit. So we first calculate the probability of increase. And then we calculate the expected return. It must be equal to 5%, right? We verify this. And then suppose that at the end of the 3 months, the stock price is 20.59, right? So in that case, investors know that when the option finally matures in month 6, that is 6 months later, then the option value will either be 0 or 196.95, right? Let's go back to the graph, right? If we go down this path, it could either be one of the two, right? So now in that case, it will be either 0 or 196.65, right? So then we can calculate the expected value of call in month 6, right? This is the possible payoffs. This is the probability rise we just calculated. And when we get the expected value of the call and also the value of the call in month 3, right? Discounted by this interest rate. And if the stop price in month 3 is this one, 620, the option value is 93.22, we just calculated. And if the stop price is lower than the exercise price, then of course the option value is 0. And again, there could be, this is the probability increase, right? The expected value in month 3, then it will be this one, right? So then the value today, we discount this value to now, right? Now we get the value of the option today. In general, I mean, we don't stop at like 2 stages or like 3 stages. We can do it infinitely many small intervals, right? So for example, one move in 1 month, 1 week, 1 day even, right? So at the end of the day, we can write down this, we can write down this upside change or downside change in terms of continuous time, right? This is a general binomial method. And here the upside downside is the change in percentage terms. This E is the base for natural algorithm. This delta is the standard deviation of the stock return. This H is the interval as fraction of a year. So we can use the formula here, right, to verify our previous calculation. So when we say the Google stock price can go up by 20%, go down by 20%, so here H is 0.5, right, over 6 months, H is 0.5. Then we can verify this by using the standard deviation, this one, right? We can verify this. 1 plus the upside change is 1.25, right? So the upside change is 25%. The downside change, same thing, right? We get the downside change is negative 20%, right? That's downside, that's going down. And then we can do it as well for 3 months, right? And then these are all consistent with our assumption of the downside change, upside changes. And this is a summary of what we have here, right? So given the standard deviation, given the changes, given the interval, we can calculate the upside change, downside change, and the estimated option value. And this is finally, we have the Black-Scholes value, right? Which we're gonna look at in just a little bit. So calculating option values by the binomial method is basically a process of decision tree, right? You go to the last one and then you go backwards. Eventually, the possible cash flows generated by the future events and action that folded back to your present value. And as the options life is divided into more and more sub-periods, like 3 months, 1 month, 1 week, 1 day. The distribution of possible stock price changes approach a log normal distribution. Looks like this. Log normal distribution basically is you can think about that is it's a variation of a normal distribution. If it's a normal distribution, then it will be like symmetric. If it's log normal distribution, then it's a little bit negative. It's a little bit leaning towards the left. So in general, we have the Black-Scholes formula, and this formula is essentially the continuous extension of the binomial method of option valuation. So in general, value of a call option equals delta times the share price, right? This is the option delta. This is the share price minus the bank loan, right? Again, this is the value of the replicating portfolio. And what is the delta here in a continuous world? In a continuous world, this ND1. This ND1 is the, first of all, D1 is this one. D2 is D1 minus delta times square root T. This ND is the cumulative normal probability density function. And EX is the exercise price. PVEX is the present value of the exercise price. T is the number of periods to exercise date. P is the actual price now. Finally, delta is the standard deviation per period of the continuously compounding the rate of return on stock. Right? So this is the Black-Scholes formula. And it already captures what kind of our observations earlier. That is, the value of the call increases with the level of the stock price, right? Decreases with the present value of the exercise price, right? And this present value of the exercise price also depends on interest rate and time to maturity. So that's why the value of the option also increases with the time to maturity and the stock's standard deviation of variability. And we can look at this example, right? These are numbers. First, we calculate, so D1, D2, and D, right? So first we calculate D1 and D2, not just by taking those numbers into the formula. And then we find ND1 and ND2, right? You can use a normal distribution table to check the value of ND1 and ND2. So this essentially means, given a value D1, what is the probability density? That will be it, right? And then plug these numbers into a Black-Scholes formula, we get the Google call options value, right? So what that means is that you can basically replicate the call option by investing this number into the company stock and borrowing this number, right? So there should be a minus sign here. So this is how to use the Black-Scholes formula. But again, you can see the central idea is to find the replicating portfolio and calculate the value of the replicating portfolio. And this is using the Black-Scholes formula, we can show the relation between value of call and the stock price, right? And this is the upper bound, this lower bound, this is the curve, right? So, and a related question is, what is the risk of an option, right? The risk of the option is basically the same as the risk of its replicating portfolio, right? That's why the risk of option will be just a weighted average of the betas of the investment in the loan and the stock, right? So if the beta of the Google stock is 1.15, beta of a risk-free loan is 0, and then we find out in the Black-Scholes model that you have this replicating portfolio, right? So in our case, we're investing 297.89 in the stock and borrow this much, right? So that's why we can do the weighted average of the betas, right? And then we get the option beta is 6.92, right? Significantly higher than Google stock. Finally, we're gonna talk briefly about executive stock option, right? That's one type of option that we see earlier in our example. For example, Oracle's financial statements show that the company issued a total of 131 million options with an average life of 4.9 years, and the exercise price is 31.02. And they calculate the average value of these options 7.47. So one kind of corporate scandal that usually happen with the option is backdating the option, right? Because companies, they grant those financial manager or the top manager their option compensation, right? Now, at what time do we value this option makes a difference for the CEO's compensation. You know? For example, company stock price has risen from 20 to 40. And at that point, the firm awards its CEO options accessible at $20. Now, it would be a problem if the firm pretends that the option were actually awarded when the stock price was 20. and values them on what basis, right? So then in that case, it will be substantially understate the CEO's compensation, right? So if they acknowledge that option will actually awarded like when the stock price is 40, then the option value will be much higher, right? So now you can see this backdating issue is understating CEO's compensation. Right? Okay, so this is so much for the option.